We have an addition to our family.
Grandkid?
Four-leg.
Oh, you.
Four-legged.
You got a puppy?
We got a puppy.
What
And
type?
She's great. She's a Cocker Spaniel.
Oh, beautiful.
Yeah, she's
Did
awesome.
you grow up with dogs, or did you have dogs when kids were growing up?
Yeah. Both my wife and I did. And she's a replacement for our Cocker who died 3 years ago. But she's fabulous.
I'm getting a boxer in January. So
They're the greatest dogs.
my boxer passed away in April.
Oh,
And this is not intentional, but over the years, I cried a lot just thinking about when she was going to die. So that I like pre-grieved. When she died,
it was okay.
I was okay. I can't believe it. Because I had really cried a lot, just randomly. If I was drunk with my wife, and I'd start crying, she'd say, "You got to be kidding me."
Right.
But so when she died, I was like shockingly okay, but I miss her a lot.
Yeah.
So she passed in April, and I'm home a lot,
Yeah.
and my kids miss her, and so
Right.
there's nothing like a dog. So
Have you identified the dog, or
I was on the phone with the breeder, so we'll only get a boxer because they're all the same dogs, personality-wise. Like they're all the same.
Right.
So I was on the phone with the breeder, and she said, "Well, I have a white bitch right now." Obviously, she's not trying to be funny,
right?
but I said, "We're looking for a fawn bitch." So she said, I got in touch with somebody else, and there's a litter coming in November. So
Right.
I can't wait. I'm really excited.
Yeah. Oh, they're the greatest dogs. In fact, our dog played with one. I think that was yesterday morning, and no, it was today actually. And she's got so much energy; she's like a maniac. And I said to her, not that she speaks English, "You're going to be sorry," because she's like this big, right?
Yeah.
And this was
she's a baby.
Yeah, she's a baby. She's 4 months old.
Oh.
And the boxer was full grown.
Okay.
And I said, "You're going to be sorry." And like 30 seconds later, the boxer went like,
Yeah.
boom.
Yeah.
But no harm, no foul.
Yeah, I miss having a dog. So this was, I don't know if this is the first investment book I ever read. I tell myself that it is. I can't quite remember. I really do think it was because I do vividly remember Googling. This is probably 2009,
Yeah.
2008, Googling the best investment book ever written.
Yeah.
And like so many other people, I read chapter 8 and I felt like I saw the light.
Yeah.
And I remember reading that passage to my mother, who could not care less. But I was so like taken with the words. I felt like I had finally somebody showed me.
Yeah.
And I said, "Oh, this is gonna be easy."
Yeah.
And then he closed the book and he started buying FAZ
Yeah, that's the irony is that's not entirely untrue.
Yeah.
and FAS with
And well, I was
reckless
perfectly
abandon.
hedged.
Right. So I'm going to scoot a little because I'm not seeing you, Josh. I'm
Okay.
going to just
Yeah.
do this.
Yes.
Is that all right?
Yeah, totally.
But then do I need to adjust? Yeah. So
we
now I've got the full beauty, the full glory.
we got people here that know what they're doing. They'll work
So
it
Jason, it's a good thing that they asked you to do the intelligent investor and not security analysis.
Well, they actually did.
Ooh.
After the 2003 edition, the last one, they did ask me to do security analysis.
It's too much.
And I said, no thanks.
It's it's a textbook.
Yeah, it's too
Yeah,
much.
and I was just like, I'm not spending a year of my life doing that,
Is that what it takes to do this? Was it a full year?
No, this was 7 months, 7 very intense months, but 7.
Okay.
But security analysis would have been over a year, and it also wouldn't have been.
It's not fun.
No, it wouldn't have been satisfying.
Did you have a chance to meet him, or did he pass before?
Graham?
Yeah.
No, before my time.
Yeah.
I was in high school when he died. Not to date myself, but
Is that the 70s?
yeah, it could be.
You once shared the last interview he ever gave, which was in the 70s.
Yeah.
Where he said explicitly,
Stop.
what I did in the Depression doesn't apply now.
Yeah.
And he was like he was one of these people that didn't like just say this is how it works and then it'll always be this way.
I remember I read a couple of his pieces in Fortune in the Depression, and there were so many stocks that were trading below cash value.
Right, in Forbes. Yeah.
Forbes, okay.
Yeah.
And obviously that condition did not persist. Thank God.
Yeah. Yeah,
0%
that's right.
chance.
Thank goodness. You never know. It might come back.
Do you think that we could have another depression-like period for stocks?
No, that's not even what was the question you asked? So if somebody asked you said definitively no, and I agreed with you.
I don't think we could have a 90% decline again.
You said,
What did I say?
will the stock market ever sell at 10 times earnings?
Oh.
And I said, no way.
I don't think so.
If it does, there's a huge problem in this country.
Yeah.
We might even be coming apart.
Yeah. I mean, I don't think you can ever say never,
Of course.
Stipulate that.
but
Of course.
I would say the odds are pretty close to zero.
Okay.
Right, because there's too much money that needs equity exposure.
Mm-hmm.
It would never get that bad. It could get bad.
Yeah, it could get very bad, but I don't think it would get.
But the
that
difference
bad.
between 50 and 90 is massive. I mean, it's not the same universe.
What, a 90% drawdown?
Yeah, no,
also,
that's death.
also impossible.
It's death.
Yeah, it's
over.
It's a huge difference. I mean, we shouldn't forget though that from the peak in 2007 to the trough in 2009, talking about minus 56%. Right?
And that was about hopefully as bad as it will get. Hopefully.
So we hope.
Yeah.
Although, minus 55 plus is a lot.
It's not nothing.
It's not nothing.
So here's how we structured the show. We're gonna do some of your recent stuff.
Mm-hmm.
Stock picks.
Yeah, we're gonna do a lightning round, and then we're gonna go into the book, and we're gonna go old school a little bit,
Yeah.
and then there'll be a musical number, and then we'll
Intermission.
no, but I wanna talk about some of your recent columns, and then I really wanna go into the Graham thing, because our listeners and our viewers. All right, I don't know how much you think about this. I think about this all the time. Our viewership on YouTube, when you look at the demographics, it's an incredible audience because they haven't heard any of these things. We sound like geniuses talking about things that you wrote on a blog 15 years ago.
Right.
It's brand new material.
Yeah.
These people are 27, 32.
Sure. Yeah.
And it's so important for them to hear this stuff.
Mm-hmm.
So I definitely want to make sure that we do that justice as well.
I'm so excited for this, Jason. Not to embarrass you, because I know you love praise, but you are the greatest financial writer in my lifetime.
Before other people came along. Yeah.
No, for real.
No, I think
for
that's
me, you're the GOAT.
I don't think it's. I don't think anyone would dispute it.
Yeah. Well, can we
Invest in
change
columnists.
the subject now?
No, fine. I think like you and Morgan Housel right now, like living investment
Morgan
columnists.
copied everything Jason said already.
Nice. Very nice.
I beg to differ.
Yeah.
He's like,
Very nice. So, all right, how we
all
looking?
right, John, we good?
Good.
All right.
Can you come in?
He's a very important man. He doesn't do small talk.
3 claps.
He did enough kibitzing. Listen up, folks. Time could be running out to lock in a historic yield at public.com.
But you could lock in a 6% or higher yield with the bond account, Josh.
But here's the thing. The Federal Reserve just announced the big rate cut, and the plan is for more rate cuts.
I'm not so sure about that.
We're going to see at least one more,
We'll
I
see.
think.
We'll
okay. But look, if you're looking to buy a home, that's good news. It might not be so great for the interest you're currently earning on your cash.
So if you want to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds, we're talking Apple, Microsoft, you know who they are. You might want to act fast.
And the best news is it's fast, it's easy to set up an account and sign up at public.com. Once you lock in your yield, you can earn regular interest payments even as rates decline. This has been brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed. Not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account for more info. Ladies and gentlemen, welcome to literally the best investing podcast in the universe. I'm so excited for this show. If this is your first time listening, this is Downtown Josh Brown. I'm here with Michael Batnick, as always. John is here. Nicole. Duncan's here. Rob. Graham is here. You excited for this? You picked a good week. All right. And we have a living legend. Emphasis on the living part. But the legendary. I'm going to do the full bio for you, Jason, okay?
Yeah.
Jason writes the Intelligent Investor column for the Wall Street Journal. He also writes Back in Business, an occasional column about financial history. Jason is the author of Your Money in Your Brain on the Neuroscience of Investing and is the editor of the revised edition of Benjamin Graham's The Intelligent Investor. Before joining the journal, Jason helped Daniel Kahneman write the book Thinking Fast and Slow. He was a senior writer for Money Magazine, a guest columnist for Time Magazine and CNN.com, and a senior editor at Forbes. Almost done, I swear. Jason won the 2013 Gerald Loeb Award for personal finance and personal service for his column, The Irrelevant Investor.
No, that's me.
So who put that in there? I know that's not him. And received the 40th Elliott V. Bell Award from the New York Financial Writers Association in 2020. Jason Zweig, you are, in our eyes, you are our idol. You're somebody that we've learned so much from. We could not be more excited to have you here on the show. Thank you so much for coming.
Yeah, thanks for having me, guys. And you should get your eyes checked, Josh.
Okay, no, I don't. I'm gonna stop with the sound effects very shortly, but I have to tell you, this is a huge show for me. And I've interviewed you before, which we'll talk about later.
Yep.
But this thing has been on our calendar even before you said yes. I put it on the calendar anyway. I think I willed this into existence. You don't do a ton of media. You like to let what you've written stand for itself. And I've always appreciated that about you. I don't have that problem. I'm opening an Arby's down the street after this. What is it about, do you think, what is it about your persona and your standing in the industry that sets you so far apart from so many people who have opinions on investing or opinions about markets? You seem very comfortable to just do the writing, let it speak for itself, move on to the next topic. You're not promotional at all. You don't love being praised, and I understand that. Believe me. No, but you seem to just have this way about you where it's about the work. Tell us about, is that something deliberate or is it just your personality?
Wow, nobody's ever asked me that before, Josh.
I'm very good at this.
Yes, yes, you are.
And humble.
Yeah, no, I have to think about it for a minute. I guess the way I would answer it is I would say that I've learned that I should take my work seriously, but I shouldn't take myself seriously.
Okay.
And another way sometimes I express that is that there's a lot of my ego in my work, but I don't have any ego for my work. I'm not I don't get swell-headed about something I did.
You get something right, 2 years later, everybody comes to the same conclusion that you already had. That doesn't do anything for you?
It doesn't, and that's because I constantly remind myself that I've gotten a lot of stuff wrong.
Okay.
And part of that is because, what's my role? I mean, it's like you guys, you have to call a lot of shots, right?
Yeah.
And the more shots you call,
yeah, well, of course,
the more shots are going to go wrong. And fortunately, I only do it once a week.
Yeah.
Or, well, I guess 6 times a month, more accurately. But if you think a lot about your mistakes, like Charlie Munger always advised, and Michael wrote a book about that, I would never use the word humble. I hate that word. I wouldn't say it keeps you humble. It just keeps you honest.
Yeah.
Which is better than humble, because humble is kind of fake. Whenever you meet somebody who talks about humility, it's really bragging, right?
Yeah. Oh, I have so much humility because of how great I am. Therefore, I need to be extra humble. Yeah,
yes,
yeah.
Yeah.
Absolutely. I hate on the LinkedIn posts that start with, I am humbled to announce. Are you though?
Yes.
Are you really humbled to
No,
announce?
I'm proud to
Right.
announce.
Proud to announce. So, all right, but so you have it, in my view, and I think most people would agree with this, you have spent the better part of, is it 40 years? 36 years?
30-some.
Okay.
Let's not count.
You have spent the better part of 36 years serving as an advocate for the rational individual investor and professional investor, but you don't wave a flag saying that you're doing that.
Mm.
That's what I mean by the work standing for itself. If somebody had spent the last couple of decades reading your stuff, they have probably done pretty well. And you don't earn a lot of plaudits necessarily for, every call that you make or every every scam that you unravel, but like I think the body of work itself really speaks volumes. And I'm just curious, how have you resisted the temptation all these years to not get to a point where you're just like, I need to make some more money, doing what I do, or I need to do a subscription product, or I need to do my own newsletter. Like you kind of just have always been you. And I think that's like a really special thing over this long period of time.
Well, I guess the way I would think about that, Josh, is like for somebody who does what I do, I'm like the luckiest person alive, right?
Okay.
I mean, I've got, look, Wall Street is the greatest show on earth. I've got a front row seat at the circus.
Yes.
I mean, not everybody is old enough to remember like Barnum and Bailey, but it's like that was their slogan, right? The greatest show on earth. Yeah. And Wall Street is the greatest show on earth. You've got clowns, you've got animals, you've got.
What's the Fred Schwed quote that he opens where the customer's yachts? He says, Wall Street has a
graveyard at one end, and a river at the other,
and a kindergarten in the middle,
and that ignores the kindergarten in the middle.
Right.
Yeah.
Jason, were you ever tempted to be an advisor?
Yes, occasionally.
We have an opening.
But I'm sure you've had either thoughts and I'm sure plenty of opportunities over the years. Why did you never try your hand at getting more intimate with your readers?
I guess I like having a big audience, right?
Yeah.
And the fabulous thing about working at the Wall Street Journal is, I get to call my own shots, and I get to have the chips fall where they may. I mean, nobody tells me, oh, those people are big advertisers, or you can't say that because you'll offend somebody or
Battle
other.
shares.
Yeah. Or whoever.
Yeah.
I mean, it's like, and
by the way, this show's sponsored by Battle Shares.
No, Yield Max.
The good folks at Battle Shares.
Yeah.
Well, so
they are good folks. I mean,
but so when you're in that position and you can call your own shots, part of that is because you chose the right publication. Think about like all the publications that have come and gone. Do you think you got lucky going to the Journal and staying there? Think about how many people were at Fortune and Forbes and Smart Money and Kiplinger's, and like everything seems to have come apart. The Journal is still the Journal. And I think that's in part because you're there. They've got amazing reporters covering every segment of finance, but you kind of got lucky that you didn't have to bounce around that much. Did you know that was that part of why you chose to go there in the first place? And part of why you've stayed all these years is that stability.
No, it was luck, like most things in my career. In 2007 and 2008, I helped Danny Kahneman with his book. I went on book leave from Time Inc., where I was working then, and
that's when you lost your hair.
And that's when I lost the last of my hair. Yeah. And you should talk, by the way. That was well timed. The book project was ending. My role in the book project was ending, and I could tell that I had a decision to make. Like, am I going to go back to Time Inc. full time, or am I going to try to find something else? And if so, what?
Okay. Time Inc. was CNN. CNN.com?
No, it was I was at Money Magazine.
You had Money, okay.
And I did like some guest writing for Time and for Fortune, but my base was Money Magazine. I had like a periodic guest column in Time, and I wrote a little bit for Fortune as well, but mostly at Money. And I wasn't sure I wanted to go back there full time. And then by happenstance, my dear friend Jonathan Clements said, I'm leaving the Journal. Do you want to interview for my job?
Yeah.
And I said, yeah, I want to interview for your job.
Yeah.
And that's it. If he had not left to go to Citi, where he went, I don't know where I would be today. Probably not at the Journal. I don't know.
So that's the personal investing column
Mhm.
Okay.
Mhm.
And you've been doing that ever since, and it's a long time now.
Yeah, it's thanks for asking. It's 16 years.
Okay. All right.
So,
Okay. So I first met you. I had a meeting at the Wall Street Journal in 2010. They were trying to solve for what do we do with all this blogging?
mhm.
They had great reporters, but reporters, as you know, are not bloggers.
That's
It's
right.
two different disciplines, two different skill sets.
Yeah.
Now, over time, a lot of their best reporters learned to blog because that became the way people receive their news.
Yeah.
So anyway, they called me. They said, "Would you like to write a blog for the Financial Advisor column?"
Mhm.
And I said, "Yeah. Who am I going to write it with? Like, I'm not going to do it every day." They said, "Well, it's a daily blog, but you're going to have help. We're going to bring in James Altucher." I said, "Oh, that makes perfect sense." Famous financial advisor James Altucher. Anyway, I had the meeting, and the guy goes, "All right, so you'll do it?" I'm like, "Of course I'll do it." He said, "Anything else?" I said, "Yes." "Can I meet Jason Zweig?" Or when can I meet Jason Zweig? He goes, "He's over there by the coffee machine. You can meet him right now." That was a big moment for me. And then I remember starting my book like a year later, and you sent me all your tips on how to write a book,
Mhm.
like exercising in
Yeah.
between, and so all that stuff was like obviously super impactful for me. And I just wanted to mention it, but I want to get to some of the stuff that you've been writing recently. So in no particular order, but it's a really interesting time to be an investor or a trader or a regulator.
Yes.
I feel as though this is as Wild West as I've ever seen it outside of 99 and 2021. Other than those two like very obvious carnivals, this one's getting pretty close from a lot of perspectives. Is that how you see the world right now?
Yeah, I think it's. I think it's getting a little. It's getting a little kooky. I see it kind of. I see it kind of at the margins, which is where I think you first pick it up. The question in my mind is, are we seeing like the beginning of the trajectory, or are we seeing what, with hindsight, might just be a blip?
Okay.
And
Of a mania.
yeah, exactly. But
Okay.
I mean, there's like straws in the wind, right?
We're in the foothills of a mania.
Yeah,
If this
at
melt
the
up goes
very
another
least.
6 months, it'll
Yeah.
happen.
Well, hold on. Are we talking about stock prices or products or both?
It's always both.
Yeah, it's always.
But I feel like you're
both.
talking about products
The only thing missing right now is
IPOs.
IPOs, which are coming.
Right.
next year. That'll be it.
That's the
Yeah.
only thing that's the one thing you can say to discourage people from believing we're in some sort of a wild bull market, like one of the
Right.
great historic,
Yeah.
is there is no new supply coming to drown us with, and eventually it
It's
always
coming.
shows
It's
up.
coming.
Yeah, but I think it's important to like keep everything on our dashboard, right? On our visual.
Okay, options,
dashboard.
volumes, and innovation and options.
Yeah.
Check.
Yeah.
The race to do alternatives, anything but stocks
Yeah,
or bonds.
yeah.
The race to sell alternatives, which is its own carnival.
Right, and package them
And package
in
them.
liquid
ETFs.
products.
The
yeah.
drop in price to launch an ETF, it's effectively almost free at this point.
Yeah.
Zero fee
So
trading.
the idea is
Mhm.
coming along as a
Yeah.
result.
Yeah.
No fee trading. Like there, a lot of on the dashboard, a lot of the stuff is already.
But
red.
I'll take
Yeah.
maybe not the other side. I don't think this is going away. And I said this in 2021. People don't get unaddicted to habits that they develop, even in a bear market, and they were washed out and they didn't go away.
Yeah.
So the one silver lining that maybe I'm grasping at straws here, and I'd love to hear your take. Are people being responsibly reckless? In other words, are they?
Yes. Jason says yes. They're being responsibly
They're
reckless.
doing what they do in their 401k, and hopefully, a lot of what we would call the circus is really gambling, and nobody's under any illusion that it's anything else but that. And for the bulk of their money, they're eating their fruits and their vegetables and whatever. And for this, they're partying.
That's a good question.
Yeah, it's a really good question, and I've actually sort of tinkered with trying to answer it, and I can't find anybody out there who really knows how to measure it. But my hunch is you're probably right, Michael, and I hope so. Let's pretend financial markets didn't exist. And let's just think about how American society has changed in the past decade, 15 years, I'm not sure. You can't drive down a highway without seeing signs for casinos, FanDuel, you can't watch a football
They
game,
completely
a baseball
co-opted
game.
professional sports. It
Every,
went from a ban to, these are bigger sponsors than beer companies.
right.
It happened in 3 years.
Yeah. And poor Pete Rose. I mean, the guy dies like in a state of lifelong shame
Yeah.
for doing what every person in America does now when they watch a game.
Yeah.
And it's like, now we're going to be gambling on the presidential election.
Yeah.
It's like it's everything.
If you come up with a product like 0 days to expiration options, there's no part of you that's bringing that into the world thinking that that's for any legitimate investing purpose. You've just invented something for people to do recreationally.
Yes.
If you're the user, you also know you're not investing. You have to know. So it's Michael's question. I think it's a really good point, or his statement. If people are investing ironically, or if people are saying this isn't investing, my investing is in my corporate 401k.
Yeah.
This is what I do for fun. I'm like kind of okay with it.
One more optimistic take on this, and I'm really trying to remain, this is not the dumbest shit ever, which of course it is, but is that how long does it take people before they figure it out? We're like, oh, this is just dumb. I'm not going to do this any longer. And I think that the earlier you learn how dumb speculation is, and I love to speculate, I love to gamble, but the earlier you learn how fruitless it is, the sooner you'll forget about it.
Yeah, so we hope, right? There's a wonderful anecdote in one of the Richard Feynman books, the great physicist. I forget which book it's in.
Let's go with Charlie, you must be joking.
I think it is in Surely You Must Be Joking, Mr. Feynman. He talks about how he went to a conference in Las Vegas or something, and he goes to the craps table, and he like watches for a few minutes, and he's like, "Oh, I know how to, I got it."
Yeah.
And then he like bets all the money he has, and he craps out, literally, right? And then he says, "I can't believe how lucky I was that the first time I ever gambled, I lost all my money."
Yeah. I said this during the GameStop phenomenon. So I would go on TV, and of course, like the professionals, everyone's in their suits, and they look down on this activity. But I think I was still young enough to remember at the time what things were like when I first started investing, and we weren't any smarter. We might have thought that we were taking it more seriously, but we were in chat rooms talking about iOmega.
Yeah, right.
And we were buying IPOs like Pets.com and eToys and all these, and we all blew ourselves up.
Right.
So then 20 years go by, and our children are doing this. We weren't any better. We just didn't have the same speed of communications that they had.
That's correct.
So every generation learns by starting out doing dumb shit.
Right.
Every one of them, I feel like.
Right. So let me agree and then let me disagree.
Okay.
So I did the same thing, right? I mean, when I was a baby financial reporter, first at Time Magazine and then at Forbes Magazine, I bought all these actively managed mutual funds because what else could you do in the 1980s, which is, I'm dating myself, late 1980s.
This is Jerry Tsai and those
no,
funds?
I'm not that old, Josh.
Okay.
Dreyfus?
No, it was like American Century, Vista, Fidelity Select Gold. I mean, whatever. Right. The Lindner Fund, all these mutual funds that basically don't exist anymore, right?
Right.
And
those were the Kathy Woods of the day.
Exactly.
Yeah.
And, I bought them. I'd hang on to them for a few weeks, a few months. If they went up, I sold them. If they went down, I kept them.
Yeah.
And I, of course I concluded I knew what I was doing, right?
Right.
And I didn't.
Right.
And was it educational? Yeah, it certainly was. But let me take the flip side. I think all of this is true, but up to a point, right? Which is when products and also when user interfaces are designed to exploit the pitfalls and the shortcomings of the human mind and to literally addict people.
The confetti at Robin Hood.
It's not just Robin Hood,
Right.
although it is Robin Hood, but it's not just Robin
Well,
Hood.
they took it to a funhouse level, but
Right.
every brokerage app wants you to do more
Yeah,
trades.
it's not just Robin Hood. I mean,
Yeah.
open any of them,
Yeah.
Webull,
Yeah.
whatever it might be.
Yeah.
And when it's designed to exploit people and basically to turn them upside down and shake them for change and get all the money to fall out of their pockets and clink onto the floor, that's a problem. And the analogy I use in the new edition of The Intelligent Investor is we don't teach kids how to drive by having them crash cars into brick walls. We don't teach teenagers
Right.
how to drink responsibly
Here's a funnel with
Here's
vodka.
shots.
by saying here's 50 bottles of whiskey, drink them.
Yeah.
And we don't teach gun safety by giving
Live
people
rounds.
an AK-47 and saying shoot at your foot.
So you do have a
Well,
point.
and then there's a layer on top of the building the user interface in such a way that it would be really easy to transact. It would encourage you to do more. And then there's this disingenuous layer on top, which I think nobody cares about anymore, where, but it's free. It's like, it's free. It's free trades. And
Yeah.
we all, now at this point, everyone understands it's not really free. It's subsidized, but it doesn't really matter that much.
Right.
Okay, fine. But I think though, you have to say somebody was going to do it.
Of course.
So they came along and did it.
Right.
But somebody was going to, instead of creeping along very conservatively, they were already using celebrities in the ads as early as 1998, 99.
Oh, yeah.
Jackie Chan and Shaq and
Joe
Anna
Montana
Kournikova.
was in an
Phil
ad.
Jackson.
Yeah.
So that was already, so somebody was going to go all the way and just say, hey, this is a game. And that's what they did.
Yeah.
And now ironically, they're getting more serious.
Right. But this is, I agree with you, Josh. This is not new. I mean, I remember when the first conference I ever went to for individual investors, which was decades ago, I would meet these people in the hallway and they were like these, 80-year-old
Velcro
dentists
shoes.
and exactly. And they would say, "Oh, I play the market," and that was the phrase people use. I play the market.
Yes,
it's been viewed as a game for.
Well, the money game. What did he write? What did George Goodman write? The 60s?
Yes, 1968.
So what would Ben Graham think of the market today if he were to be dropped and he could see the shenanigans?
I think he would hate it, but you have to realize that Graham, he had a puritanical streak, but he also was very realistic. So he would hate it in the sense that he would never participate in the manic aspects that we're talking about, but he would understand why people do it. And he wrote extensively in The Intelligent Investor about the people have to let off steam.
Yeah.
And the example I always give is if you're in a casino, even if you're just there as an observer, a spectator, I mean, if you look at the person next to you, that person has insurance. They're not like a risk-seeking maniac. I mean,
they're not riverboat gamblers.
Yes.
That's right.
They're there for fun. And in the other aspects of their life, they might be very conservative.
I like hearing you say that you believe the two things can coexist.
Yes.
You can have people responsibly investing and then on the side doing some Batnick-esque stuff. I think I want to. All right, so I want to.
The key is you have to contain it and you have to structure it,
and you have to not believe in your own bullshit.
Exactly.
When you have a big win, you really have to memento mori yourself into not think, oh, I'm going to start a hedge fund now, which I've seen people do. Solving the mystery of an investment that's too good to be true. You did a column on September 20th. It was a promise of a 17.1% return. And when you peeled back the onion, I know you'd spent part of the summer doing this. You came to find out that there were a lot of things being promised in the way of yield that just are too good to be true. I feel as though this is one of the hallmarks of the modern era is not just the chase for yield, which is always, but these insane promises that you would think like adults would know better, but they seem to have to relearn it over and over again. When I was coming up, there were things that were like 12%. Now, people don't even get out of bed for that. They want to hear 17, 18, 25. Tell us about this column and how you first came to start covering yieldwealthmanagement.com and these types of things and what the resolution was.
Yeah. So, I heard about this outfit. It was called Yield Wealth, which was an RIA, registered investment advisor. And it was offering these private placements that it called term deposits. And from the various websites associated with it, it really sounded like a bank product.
Yeah. Term deposit sounds official.
Yeah, exactly. The term deposits makes you think it's a bank. And it was offering other products that were FDIC insured. And then it said these particular products had millions of dollars of private insurance, including from Lloyd's of London. And none of it really passed any sniff test.
Here's an example of the advertisements. Colossal yields without the risk. Colossal is probably a tell. Fully insured guaranteed. That's a double guarantee, it sounds like.
Yeah.
So they were saying these things everywhere on the internet. Okay.
Right. But look, people, part of being human is you want to believe in magic.
Yeah.
I mean,
what did your dad say about that famous line?
Oh, about lying to people? Yeah. So if I can remember it right, he said, if you
tell people the truth who want to hear the truth, you'll make money. If you lie to people who want to be lied to, you'll get rich.
Yeah.
And if you tell the truth to people who want to be lied to,
you'll go broke.
You'll go broke.
Yep.
So, all right, in this case, these people know exactly what they're doing.
Yeah.
They're pressing the greed button.
Yeah.
And enough people respond to it.
Yeah.
Okay.
Yeah. So, I'm still looking into this. I don't know if there'll be a follow-up. But they raised tens of millions of dollars from people. And, the story changed. Initially, it was sort of like arbitrage trading in gold and other trade.
Like how they're able to make that yield.
Yeah, exactly. Where
Right.
did the yield come from?
Right.
And then it ended up something along the lines of we buy Obamacare policies at a discount from the federal government
Right.
and hold them for a month and then resell them evidently back to the government.
So stories that are plausible enough for a investor that doesn't know anything.
Right. Or for a lot of the people selling it in the field.
So certainly Graham would not be surprised by this behavior. He'd see it every scam back in the day.
That's right.
The Fed made its move. Why didn't I?
Let me read a quote from Jason's article that I was nodding my head in solidarity. Ignore the shouting. Instead, use this month's 0.5 percentage point cut in rates as a quiet pretext for the simplest possible fix, moving money out of cash that you never intended to leave there in the first place. I'm telling you this largely to shame myself into doing it too.
Tell us what this column was about.
Yeah. So, when the Fed cut rates 0.5 percentage point in September, it occurred to me that, there was going to be a lot of coverage of like, what does this mean for your bond portfolio and how's the stock market going to respond?
Yeah.
And I said, isn't there something like even more obvious, which is, holding cash just got less lucrative.
Right.
Because
Overnight, literally.
And do people know how much cash they have? Like a lot of people don't have enough cash. Some people maybe have more cash than they intended. And then I said, yeah, like me. Because what triggered this for me was, first of all, I got a study from Vanguard saying that, basically millions of Americans have rolled over IRA money and then rolled over 401k money into
an
IRAs,
right?
and just like left it sitting in cash.
Well, here's your number: a Vanguard analysis of approximately 279,000 direct contributions made by its clients to IRAs in 2022 found that at more than 55% of these accounts, the new money stayed in cash for at least 12 months.
Mm-hmm.
So for most people, they're not using that cash that's in an IRA. They can't. So it didn't hurt them in 22 to be in cash.
Yep.
In 23, it didn't hurt them. It didn't help them. But now those 5.5% yields are off the table.
Yeah. And, the point I wanted to make with people is it's fine to have money in cash. Maybe you should have more in cash.
Right.
But it's not fine to have it there if you didn't mean to have it there. And in my case, part of this was an inherited IRA. And, after my mom died, I said, I'm going to take this money and I'm eventually going to put it into individual tips, inflation-protected treasuries. And, I'm busy handling my mom's estate right now. And as soon as I get that all settled, I'll do that. And then like a year went by and then a year and a half, and then I forgot about it.
And you're being paid to not do anything.
Yes.
Well,
Exactly.
the irony of it is how much did the S&P 500 go up from the time overnight rates hit 5.5%? I'm making it up. Is it 40%?
Yeah.
Like the market,
30-something.
the market
Yeah,
is
for
very
sure.
cruel.
Yeah, exactly.
So, which is this one?
Buffer funds. We definitely.
You know what, Jason? Very often when I'm thinking through markets, I think a lot about what you would think about this, and I'm really, really curious to hear your take on buffered ETFs. I think we might.
Can you define what this is for the listeners?
So buffered ETFs are ETFs that have options embedded in the vehicle, and they're basically guardrails. So you don't get all the upside, you don't get all the downside,
but you have exposure.
But you have exposure. And I spoke to Bruce Bond in 2018, and I remember saying to him, this is one of the best calls of my career. It was so obvious to me that this is going to be a massive category, because the idea that you could define your risk is supremely attractive. Now, when you have a 60-40 portfolio, 70-30, 50-50, whatever it is, like a range of outcomes, but you're still beholden to where the market goes. With this, you could say, okay, 10% upside, 8% downside. Nah, I don't like that. Oh, okay. How about 15% capped and 20% downside? Like whatever it is, the fact that you can define your outcome, not everybody wants all the smoke. And I don't hate it. I kind of like it.
For wealth management, especially.
Assuming that it's used correctly, of course. I think it's a product that has a place for people that need it.
Now let them have it.
Yep.
Yeah, no, I guess what I would say is I don't totally disagree, right? I think it's super important for people to understand the trade-offs, right? And the key thing here is because I imagine, and I don't know this for a fact, but I imagine that most of the purchases in these buffered funds are intermediated. A financial advisor is putting a client into these funds.
I think that's true.
Yeah.
And if you're doing it yourself, if you're self-directed and you're making this decision yourself, you got to really do your homework. But if your financial advisor is doing it for you, you'd better be damn sure, and I don't swear a lot in public, you better be damn sure that your financial advisor understands how these products work. They are not simple.
I want to go a little bit deeper into this. If you're a financial advisor and you make this, and you have a category of clients who are risk averse, not just temperamentally, but because of the stage they are at in life.
Yep.
And you want them to have equity exposure, especially if rates come down, because you still want them to grow, but you want to give them, I don't want to use the term certainty, but to Michael's point, you want to give them some like guidelines of how this goes wrong, how this goes well. It's asymmetric, and you give them that, and they say, "I really appreciate you giving me a little bit more certainty than I would get in just a 60-40 mix." I think you could say that you're doing your job well because you're matching the strategy with the type of client that needs it. Here's the problem: the S&P triples, and that client only got capped at 15% upside a year. So they compounded significantly below.
Yeah.
And you kept on with the strategy and the market kept outperforming it. We know this is what's going to happen in the long run anyway.
Yes.
Is that actionable if you're an attorney representing that client? Is that an arbitration?
Could be.
You did it. You put my client in equity risk and left all of the upside on the table for your other clients.
Yeah.
Why did you do that?
Yeah.
It's hard.
The opportunity cost potentially is huge.
That's the risk.
And it all depends on what the slope of the stock market looks like in the future. I mean, if we get the 1966 to 1982 period all over again,
then you look great.
You look like a genius. Yeah. But if we get the 1980s, the 1990s, or the past, or most of the past
good news is you're
decade.
fired if that happens.
But
eventually,
here's what actually does happen, and I'm in this business a long time. What ends up happening is that client who was 75, 10 years go by, they're 85. They're now opening up the kimono of their finances to their family members, and there's a son who's 45, and he's an MBA, or he's very bright.
Yeah.
And he says, surely my dad made a ton of money. He's been invested all these years. He opens the statements and he says, what the is this? Where's all the money?
Right.
Look at what the market just did.
Right.
And then he says, what is this buffer? Explain what you did. And you said, well, I wanted to take less risk for your dad.
Mm-hmm.
Like, you get into a situation where the hindsight is the problem.
Right.
This is what you said. I like to call them armored funds. You like armored better than buffer. I do too. More evocative. Like medieval knights, these ETFs wear shining armor that can protect against the slings and arrows of outrageous market fortune, like the 18.1% loss on stocks in 2022. But armor is a clunky hindrance. To buy that buffer or protection against loss, you relinquish your right to participate fully in the potential gains. Your returns are capped. So yeah, it's armor until the market rallies, and then it's like dragging an anvil.
Exactly.
There's no doubt. We'll never know. There's no doubt that advisors are selling this inappropriately, lying to their clients. Of course, that's happening. Mm-hmm. However, for the intelligent advisor who knows their clients are skittish, who knows that they would have no shot at staying invested, even as in a 60-40 portfolio, I think there's a place for this to be a sensible solution. But of course, context matters, and the story that they tell matters a lot.
Yeah. I think there's a simple test. If I were the client and my financial advisor were telling me that I should be in one of these buffer funds, I would say, I want you to open on your computer, I want you to open the page from this buffer fund you're recommending where it shows all the potential outcomes, because all the sponsors of these funds, as a very healthy public service, model how these funds will perform under various scenarios. But the models are not intuitive because it's
intuitive to the reader.
Exactly. It's options math.
Yeah, it's
it's
complicated.
all options math. It's like it's a series of dynamic if-then propositions. And it's all driven by option math. Mm-hmm. And I would say to the advisor, explain what's on your screen.
Well, I'm out.
And if the advisor can do it, I'm in. Yeah. But if the advisor can't explain what's on the screen, then screw it.
Can I ask you an advisor question before we jump to the intelligent investor?
Yeah, sure.
I think you must approve of the evolution of the industry where we have less and less rep as PM running around. Mm-hmm. We don't really have as many, you can call them brokers or financial advisors, regardless. We don't have as many of them running their own client portfolios and doing different things in different. It's a much more centralized CIO industry now. So the largest funds, they either use an external TAMP or they have a global CIO. They have model portfolios. The advisors are spending a lot more of their time on the planning side and a lot less of their time picking stocks, picking mutual funds.
Thank God.
You must. Yeah. I'm assuming you must approve of that evolution in broad strokes, at least.
Yeah, I do. And there was not to sound critical, Josh, there was a lot of jargon in there. So for like our younger listeners, what we're really talking about is that, as the industry evolved, financial advisors used to be, first they were mutual fund pickers.
Mutual fund experts.
Right.
Yeah.
Then they became ETF pickers. And now then they became asset allocators.
Now they're unlicensed psychologists.
Yeah.
That's better, right?
Exactly, right?
Okay.
And yes, that's a healthy evolution. I think there's one thing we have to be careful of, right? Which is in the financial industry, my general rule is that all the problems are not in your visual field. You need really good peripheral vision to see where the trouble is.
Yeah.
Because the stuff that's in front of you is probably no big deal, right? And what's happened is there's enormous hydraulic pressure in the industry to minimize lawsuits, keep arbitrations to a minimum, stay out of trouble, keep your nose clean. And that doesn't mean that there's no bad actors. It just means they're not in the mainstream anymore. So the guy who used to be a shyster working for a brokerage firm is now a shyster working for himself. Right. And he's probably selling harder and pitching even worse garbage than ever. He's just not doing it through a brokerage firm or a registered investment advisor. He's still out there, and people are still getting victimized.
He's selling private investments.
Yeah.
Yeah. And because that's the last thing left.
Exactly.
He can't be platformed any longer at a custodian or at an independent broker-dealer.
Right.
They don't want the reputation risk. It's not worth it.
Yep.
So that guy's out there doing a full-blown Ponzi.
Right.
Yeah. I think by and large, though, getting rid of probably 2,000 former NASD regulated firms or former FINRA regulated broker-dealers probably cleaned up a lot of it.
Yes.
At least in the mainstream, to your point.
In the mainstream, I agree with you. It's cleaner for sure.
You wrote about you're not paranoid. The market is out to get you. I love the premise, and this is to talk about the new book, which we're going to get to now. Investing isn't about mastering the markets. It's about mastering yourself. That was the central tenet of Benjamin Graham's The Intelligent Investor, and in part, why Warren Buffett has called it the best book about investing ever written. First question is, do you agree with Warren Buffett? Not just because you're involved in editing the new edition. Do you think it's the best book about investing ever written?
It's most influential, for sure.
Yeah.
And have you read my new book yet? Because I want you to have all the information.
Yes, I have. I have read your excellent new book,
Thank
Josh.
you.
And as you know, I quoted it extensively
Yes.
in an issue of my newsletter. Well, first of all, let's quote Ben Graham, who said that my book has been read and disregarded by more people than any other investment book ever written.
Right.
And I think that's a pretty accurate description. So the book, over the years has been a massive bestseller for, 75 years.
It's still front page Amazon. If you type in investing on Amazon.com,
It's the first book. It's the first book, yeah.
Yeah. That's the one.
Yeah, I mean, I don't know. I guess the best anything always makes me a little squidgy,
Okay.
when people say, what's the best movie ever made? I'm always like, the best movie ever made?
It's on the Mount Rushmore.
Well, so Buffett would say that, and most people would defer to Buffett.
Mm-hmm.
I think if you approach Wall Street more of a trader, you would probably say reminiscences. Like Paul Tudor Jones would say Livermore.
Yeah.
Yeah.
Because he doesn't do what Ben Graham did.
No.
Yeah.
So I think some of this is just a difference in in discipline. But anyone who's a long-term investor would have to have this as a top 3.
Yeah.
Yeah.
I would think so.
You wouldn't take them seriously if they didn't.
Yeah.
So, okay.
Yeah.
So you wrote this column. I think it was an excerpt from the book, and I love this part. I just want you to riff on it. We spoke about this earlier. You said there are no barriers to entry, no way to authenticate claims of expertise, and no registry of how accurate the opinions are. That can degenerate the wisdom of crowds into madness. The weight of an ox doesn't change with people's estimates of it. However, if thousands of speculators decide a stock or cryptocurrency is worth $100,000, it will skyrocket, at least temporarily, even if it's worthless. And to me, this, you called it the gamification of the markets. To me, this is the biggest difference between how markets used to behave prior to the internet and how they behave today. And there's no going back. There's no going back.
No, as we talked about earlier, I think, this is the permanent state. And I think, it's never been easier to invest, and it's never been harder to invest intelligently.
That's a really great way to frame it.
Yeah. And, when investors, what are most investors pressured into doing? They're pressured into getting better at things that make them worse.
Say more. Say more.
It's like, do I really need to trade zero date options? Do I really?
But where is that pressure coming from? Because I don't do that shit. No, I don't.
Yeah,
I don't trade crypto. I invested some in it. I just leave it. I don't feel that pressure. So I don't think everyone feels like they have to do these things.
Well, it's coming from your phone. It's coming from your friends.
The news.
It's coming from the news. It's coming from the billboards on the highway.
I think you're talking about the new investor who comes into the market and they see, oh, it's a casino.
Yeah.
Right.
Right. And the thing is, it's like, it is a casino, but you have to think about it two different ways, right? A casino, if you're a customer, is a place where you go to lose money.
Right.
A casino, if you own it,
it's great.
Is a place where you mint money, unless you're Donald Trump. Never mind.
Right.
I didn't say that.
So the longer you stay in a casino, you're sure to lose money. With the stock market, it's the exact opposite.
Right. But if you own the casino, you're sure to make money. And the thing is, it is a casino, but the question you should be asking yourself as a new investor is, do I want to play in the casino or do I want to own the casino? Right. And, look, you buy.
But how do you own the casino?
You buy a handful of index funds and you hold them the rest of your life.
And that makes you a casino owner because you are reaping the end result of the bets that hundreds of millions of people are making each day.
You get to free ride.
So therefore, you de facto own the casino.
But wait, it's not just bets. These are businesses.
That's right.
We forget about that all the time, but these are actual companies.
Exactly.
So you said handful of indexes, and I'm glad you said that because I'm curious to hear your take. Does the concentration of the market worry you? Or are you like, this is actually a good thing? Actually, Mobison wrote a piece recently, and he said that, no. Concentration is a feature of bull markets. And in fact, the broadening out of the rally or when equal weight outperforms is like not necessarily, be careful what you wish for. But have we gone to the point where it's, all right, Torsten Slot had a stat that NVIDIA is larger than, like, is it too much? Me too.
Yeah. Well, so it's like asking the frog in the pot of boiling water, how hot is the pot? I mean, eventually the frog will die and that'll be your answer. Right.
I wanted to ask you in that same vein, would Benjamin Graham have learned to love the Magnificent Seven stocks if he were investing from 2015 to 2025? Because he was adaptable. Mm-hmm. He's wickedly bright. Mm-hmm. He surely would have respected network effects, legalized monopolies, companies growing 20% a year top line revenue with 40% profit margins, the consumer lock-in that Apple has, the brilliance of Jeff Bezos. He would not have been immune to these things, regardless of the fact that they sell at high multiples, always have.
Well, wait a minute. We have an example. How many Mag 7 stocks does his protege own? So I probably think Graham would have said this is probably not sustainable.
But what rates. He owns one, Apple.
Right. But exactly, one.
Do you think like a modern version of Ben Graham, he would have been in these names? I think he would have. But you would know better than anybody.
Yeah, I mean, it's just now we're really speculating in the other sense of the word.
Welcome to the compound.
And it's worth remembering that the word speculate means both to
see,
look out from a watchtower and to look in a mirror. So maybe we're just looking in the mirror. But I don't know for sure. Looking at what Warren Buffett does is probably a pretty good guide to what Ben Graham might do.
You think so after all these years?
Yeah.
Even with the modifications that Munger had made in Buffett's mindset?
And the thing is, if Charlie Munger were here, bless his heart, I think he would say that Graham would not have invested in any of the Magnificent Seven
Really?
stocks.
Okay.
What Charlie told me, quite a few times is Ben Graham was afraid of the future because, in 1929, he saw what it could do to you.
Mhm.
And Graham wrote, the future is something to be guarded against.
Yeah.
He was very conservative, but he, toward the end of his life, what he did was he effectively invented what today we call smart beta or factor investing. And he bought dozens of stocks that all passed a statistical screen.
He built a screen.
He
Okay.
built a screen that identified basic value. And that's the last thing we know about his approach. And he did that after the last edition of the book came out in his lifetime. So it's like his final testament almost. And it does not indicate that he would have bought something like the
He was not return stacking toward the end?
No, he was not.
Okay.
And also, Buffett didn't even buy Apple in the first place, right?
Yeah.
It was the other two guys that did it.
That's right. Although he let them do it.
Yeah.
And then he became very enthusiastic.
You have a concept from Ben Graham about the basic advantage of investors. Can you lay that out for the people listening? What is that basic advantage?
Yeah, so this is the single most important part of the book. And it's, in my opinion, it's the single most concentrated nugget of wisdom about investing anyone has ever devised.
Hold on. Turn on the TikTok camera. That's a big buildup, Jason. Lay it on us.
Yeah. You
Okay.
got it there, Michael?
Go ahead.
We want you to do it.
So I don't have the passage quite memorized, although
We'll correct you. Don't worry.
you can correct me. But so what Graham said is that the individual investor has an incredible advantage over professionals, which is, if you're a professional investor, your performance is measured, annually, quarterly, monthly, weekly, daily, hourly, moment to moment in a lot of cases. And if you're beating the S&P 500, you're good. And if you're not, you suck.
Right.
And it's binary.
Yeah.
And if you're beating it, then you keep doing what you're doing. And if you suck, then you stop doing what you're doing.
Right.
And all you care about is whether you're above or below that line.
And it's relentless.
And it's relentless, and it never stops. And, it's why Peter Lynch quit. It's why.
And it's not just about your standing as a professional. It's tied in with like your identity as a person.
Correct.
And are you going to keep or lose your job that your family is dependent upon?
That's right.
It's so much more than just am I above or below the index. It's will I earn a living next year?
That's right.
Yeah.
And the pressure that puts professional investment managers under is ferocious.
Yeah.
And it's why this concept of closet indexing has become so powerful. And it's why index funds alone aren't just driving the market, but people imitating index funds is also driving the market. But the thing is, if you're an individual investor, you don't have to care.
Yeah.
You don't have to buy what other people are buying. You don't have to sell what other people are selling. You don't have to measure your performance on those same horizons. In fact, if you don't feel like it, you don't have to measure it at all.
There's no committee. You're not reporting to anyone.
And
Right.
you can just say, here are my objectives. 10 years from now, 30 years from now, I want to have peace of mind. I want to have a house in Tahiti, whatever it might be. And all you need to care about is whether, on average, over time, you're making progress toward those objectives. And that has nothing to do with how the market is performing.
You'd be a good financial advisor.
Yeah, maybe.
Yeah.
Jason,
And so
go ahead.
let me just finish the thought, Michael. So this is what Graham defines as your basic advantage as an individual investor, is that you don't have to think like a professional
most take
investor.
it for granted?
I think most people throw it out the window.
Yeah.
because
I think so too.
going all the way back to like Jim Cramer's days at the Street and a lot of other market commentators, all you hear as an individual investor is now you have the tools so that you can compete with the pros and you can beat them at their own game.
Which they are losing at.
Right. And that's my argument. It's like, you want me to play a game that the players lose at.
Yeah.
It's so ironic. It's never been harder, I think. I don't know, never. It's been a hard time to be a professional investor for the last 15 years because one basic advantage that the intelligent investor who just lives their life has is they don't know what the CAPE ratio is. And think about how much money has been lost for the last 15 years worrying about how stocks were overvalued.
Yep.
And if you think about professionals leaning on the lessons of history, I think they often mislead you. So I don't know if this is Peter Bernstein or William who wrote about this. I think it was Peter Bernstein. That stocks used to have a higher dividend yield.
Yeah, that was Peter.
Than bonds for forever, for 40 years. And
more than 40.
And anytime they converge.
Like 200 years.
Okay.
You could set your watch by that.
So anytime they converge, stocks crashed because they were more expensive. Yeah. And then it flipped and it never looked back.
Yeah.
Meaning bonds always had a higher dividend yield than stocks from then on out.
Correct.
Right. And the fascinating thing about that,
and that's the 1950s.
Guys,
And it's
right. But the fascinating thing about that is if you think about it for a second, that's how basic logic would tell you it should be, right? Stocks are riskier than bonds. They went down 90% in the Great Depression.
It made sense.
They went down 55% in the global financial crisis.
Why should they pay you a higher income?
You should earn more income to own stocks because they're riskier.
Yeah.
And you did from 1792 until 1956. And then you didn't anymore.
And you didn't know that was the end of something because how could you have in real time?
And the lines crossed like this.
And they never looked back.
And everybody Peter Bernstein worked with in the late 1950s said, this is unsustainable. And they said it, and they said it, and they said it, and it never reversed.
Until they were unemployed. Right.
And then, of course, we had a kind of brief shining moment where it flipped again after the financial crisis. I forget when it was, like 2000. Whatever it was.
Maybe 8 or 9.
Yeah.
So it's just this weird thing with investing where the new investor will think, I have to learn everything. Mm-hmm. And of course, we know the opposite is true. The less you know, the better off you probably are.
Could be.
So people are gonna buy this book. How are they gonna become more intelligent in the way that Graham would use that term? What do you think when they're gonna read it, they're gonna close the book, they're gonna say, that was incredible, I can't believe how much I just learned. And then what steps do you think they're going to take? If you did your job right and Graham's message is resonating, which of course it still will, what do you think the reader of the book is going to walk away thinking?
Well, I hope what they get from it, Josh, is that you have to have good decision hygiene, right? You got to clean up your environment. Starting with what Michael was talking about, I mean, we've touched on it quite a bit, like the gambling atmosphere, not just in the financial markets, but in American society. And, I think people kind of get that, right? It's like, yeah, I'm going to watch this playoff game, and I guess I am going to bet on it because everybody's betting on it. But, I'm going to bet $10 or something. And a lot of people go into it with a limit in their heads, right? But then there's people who don't.
Yeah.
And the next thing they know, they're in Gamblers Anonymous, or they're broke, or they're homeless.
They don't see it coming.
Right.
They don't see the onset of the addiction until they already have to fight.
Until it's too late. And as Warren Buffett likes to say, the chains of habit are too light to be felt until they're too heavy to be broken. And that's what you need to avoid. So
that's a good one.
You need decision structures, and that's what the book is all about.
Okay.
So you want to gamble, then you create a Mad Money account, and you decide, maybe you put 5% of your assets, maybe you put 10. You put that money in, and you have a rule, and you can't break the rule, which is I can't add to this account, because if I add to it, I've become an addict. And if I crap out and it goes to zero, I'm done.
The rule is set in advance.
If I make money, I keep going.
What's the last conversation you had with Charlie Munger?
So the last conversation I had with Charlie was in in the fall. I think it was at the end of October. So he died on I think it was the last day of November last year. And so he was 99. His 100th birthday was coming up.
What a life.
An amazing,
incredible,
amazing life. And this is a guy who overcame incredible tragedy in his life. I mean, he was blinded in a surgery that went badly. His son died when he was very young. He was had a bitter divorce. He went through all kinds of adversity. And so he told me this incredible story because I said, whenever I talk to people in Silicon Valley, especially, they really downplay the importance of luck, and because they think they're like, they got there by working incredibly hard and being unbelievably smart, both of which are true. And he said, let me tell you about luck. So he said, I was 7 years old, I think it was, and I was playing on a swing in Omaha on the street I grew up on with my best friend, this girl, and he gave me her name. I won't mention it. And he said, we were just on the swings, and she was like the brightest girl in my class. She would have been a superstar. And out of nowhere, this dog comes up, and it was rabid, and it attacked us, and it bit her. And she died of rabies. And he said, that dog was 6 inches from my face. Why did that dog bite her instead of me when we were both fighting the dog off? It bit her instead of me. She died. If that dog had bit me, I wouldn't be here today. So don't talk to me about luck.
Right.
And, Charlie had what I would call real humility. So he wasn't a humble person. Charlie Munger was one of the smartest people of the 20th century, and he knew it. And he had no qualms.
And a lot of opinions.
And he had no qualms about letting you know that he knew how smart he was. But he also knew what he didn't know. And he also knew how lucky he was. And so that's epistemic humility. That's like being able to admit when you're out of your depth. He and Buffett had this thing they called the too hard pile, which is when someone when someone would bring them something for a decision, they would look at it and they would say, either we think we can figure this out, or too hard.
He said Amazon ended up in the too hard pile, and it was one of his biggest regrets.
Exactly.
Yeah.
Yeah.
So even toward the end, he was still thinking about just how lucky he was and the role of luck in all of his success.
I think more so than ever. I think the older you get, the more the role of luck looms in your life. I think if you don't start to figure that out over time, there's something really wrong with you.
I just spent 3 days in Omaha. There are statues of pioneers. There are statues of soldiers and there's tons of like public sculpture in Omaha. Omaha's beautiful. There's no Buffett. I mean, I'm sure that'll happen after.
Right.
I was just surprised by that. I was like thinking about maybe walking past his house because I know it's like right in the middle of the town and people do that. But then I said, that's not me. That's weird stuff. I'm not going to do that.
I would do that.
So instead, that's like Batnick stuff. Instead, I emailed Larry Cunningham and I said, hey, can you get me into Berkshire Hathaway? And Larry's like, no. So I had like no Berkshire encounter whatsoever. It was a little bit anticlimactic, but I love the city of Omaha.
You didn't go to Garat's Steakhouse?
I was told don't eat there.
Yeah. It's not that good.
Don't
tell Buffett I said that.
Yeah, no, it's Mahogany Prime 1.
That place is good.
That place that place slaps.
Yeah.
The second one that everyone said to go to, which of course I did, was Omaha Prime. I don't know.
Yeah.
Unbelievable. They have too many good steakhouses. But I was just taken by the fact that Berkshire Hathaway is one of the most successful companies in all of the world. They don't have a giant skyscraper with their name on the top of it. In fact, the newspaper has the biggest, the Omaha World Herald.
Yes.
Okay. But like, there's no like Buffett Plaza or anything.
Mm-hmm.
Do you think that stuff comes eventually, or do you think he told the mayor, please don't do anything like that?
I think it does come eventually. So there's a great example that I'm sure Buffett is very well aware of, Josh, which is his really good friend, Joe Rosenfield, who's a guy I wrote about, 20 years ago, was the single biggest benefactor of Grinnell College in Iowa, but also one of Buffett's closest friends. And Rosenfield gave easily $100 million to Grinnell during his lifetime. There wasn't a building, there wasn't a professorship, there wasn't a street. His name was nowhere.
Wow.
And that was a condition of all his giving. He also was head of the investment committee for decades. And he died I think he was 97 when he died. And he said, I don't want my name on anything.
Okay.
And then when he died, they built this great big building and they called it the Joe Rosenfield, Center.
They couldn't help themselves.
Right, exactly. And I think that's probably, we'll see the, Warren Buffett thing in Omaha.
Yeah. I mean, it would be crazy if there wasn't, given the legacy.
Yeah.
So are you surprised at how well that stock has done this year? Berkshire Hathaway, record highs.
Yeah.
I think
Trillion.
Yeah.
$1 trillion market cap, which I'm glad Warren got to see that.
Yeah.
How do you feel about the transition and the communication with the shareholder class about these people are up next?
Mm-hmm.
They know what they're doing. Let them talk with us on stage. You think they've done a good job?
Yeah, I think so. I think it took too long.
Yeah.
I think like a lot of founders, his grip has probably been a little tighter than people would like. And, I think they are going to have to carry him out of there, feet first, which is probably a good thing. But everybody I know at Berkshire is just like a complete class act. I mean, these are people of extraordinary character, and they really have their feet on the ground. And I'm sure the company is going to be in good hands. I mean, look, is anybody ever going to be able to duplicate Buffett's investing record from the 1960s and 70s?
I don't think so.
Probably not.
Never again.
Probably not.
Yeah. There'll be a new Buffett every 5 years in the media, but not in real life.
Never again.
Jason, we're gonna end with, I want to show you something. John, can we get that first image up on screen? So this was one of the best moments in my professional career, and you were a part of it. In 2017, we had you come to an event we were doing. You remember this?
Yeah.
Okay. We had you come to an event that we were doing called the Evidence-Based Investing Conference,
yes,
which
yes.
was in downtown Manhattan.
Yep.
And it was the 10th anniversary of your
Right.
book, Your
By
Money
the
in
way,
Your
my
Brain.
tie was not tucked into my pants.
Yeah. No, I could see how it might look that way.
Yeah.
You look exactly the same, by the way, and that's eight
just
years
as bad,
ago.
Just as bad then.
No. This was a huge thrill for me. I got to interview you in front of an audience of hundreds of professionals, and I think we had a really good time. And I just wanted to say thank you again for doing that, because I know the last thing that you normally want is to sit on stages and be celebrated. But here's one more we have. This is you with all these copies of your book that we got. You had a line out the hotel of people that wanted you to sign their.
Yeah, I do remember.
You didn't see the end of the line.
Yeah, I do remember that.
That's a lot of books.
So you were sitting there, so you didn't see how far back this line stretched. I'm sure you felt it in your wrist. But for me, that was really cool to see. You get your due. And I thought that was awesome.
That's great. Thanks,
So-
Well, and I want to say, and I'll keep this very brief.
We are out of time.
Stop. Not to embarrass you, but you're the second person that I said I love you to that's in that chair. The first was Eli Manning, and the second is you. So, seriously, thank you. Thank you for everything.
My pleasure, Michael.
We're gonna
Give me a football and we can see what we can do.
we're gonna stop embarrassing you almost. We end the show every week with favorites. We like to give the audience something that we're reading or watching or music or anything that strikes your fancy that you think people should hear about. Mine is
Buffett ETFs.
Mine is something that you wrote called "To Be a New Fool in the World." Do you remember this?
Yes.
You wrote this on May 20th, 2018, and I thought it was one of the best things that you've ever written, and I still revisit it. and so much of what you're about can be distilled in, or has been distilled in, this piece of writing. So for people listening, this is on jasonzweig.com. Look forward to Be a New Fool in the World. Do you remember the message of that piece? I know you've written a million things.
Mm-hmm.
Okay. You still believe in that idea?
Yeah.
Okay.
Yeah. It's like, just, you have to accept the uncertainty of the world and recognize that no matter how much you learn, you're just scratching the surface.
I send this to young people who ask me about investing, or they might be interested in a career in investing. I have a folder, and there's 10 things in it, and 2 of them I wrote, which tells you about my humility. But I said, but this is in there. Anyway, that's my favorite, and I want people to go hunt it down. We will link to it in the show notes as well. Michael, do you have anything for this week?
I do. It's a coincidence. I just read this good book called The Intelligent Investor. It's the 3rd edition, and Jason, bravo. It's just as good as it was the first time I read it 15 years ago. So thank you. Thank you
I might
again.
have to revisit this.
Yeah.
I might have to revisit this. What would you leave people with? What's your favorite investing book besides your own, or what do you think people should hear about?
Well, so I think I have to recommend the book we sort of alluded to earlier, Josh.
Bailout Nation by Barry Ritholtz.
Well, that's one possibility.
Okay. All right.
French word?
But no, what I was going to say, and where is Barry? He's probably like leering at us right now.
Barry's in trading right now. He cannot be disturbed.
Yeah, all right. So in addition to that, I would certainly recommend Where Are the Customers' Yachts by Fred Schwade Jr.
That book still hits.
That book rocks.
And it's 90 pages. You could
like,
breeze through it.
It was written in 1940.
Yeah.
It could have been written last week. It's not just the funniest book about investing ever written. It's one of the best books on investing ever written. It's brilliant. It's hysterically funny. And
it should have been a movie, although not enough people care enough about investing.
Yeah, but the cartoons are great.
Just this premise of a guy sneaks into a Wall Street firm, basically. He's like, can I just sit here and watch?
Yeah.
They say yes. And then they carry on and just do exactly what you think professionals are doing.
Yep.
And he's there.
And I mean, you can read it out loud in like a group of people who don't give a dang about investing, and you can stop the room cold.
Yeah.
Not because people are saying, why is a weirdo reading from a book out loud to me, but because it's that good.
The storytelling.
The language, the prose is gorgeous, and it's laugh out loud funny.
Yeah. And I know you like Against the Gods by Peter Bernstein. That's one of your favorites.
Yeah.
Any others that occur to you off the top of your head?
The Money Game
is great.
It's so good.
Okay.
It's a pretty short list.
Yeah.
It's a pretty short list.
But those books are eternal.
Yeah.
So we agree. Jason Zweig, ladies and gentlemen. All right. Now you are still writing at the Journal, so we're going to tell people to follow you there. You are on LinkedIn, right?
I guess.
I don't know.
Is anybody on LinkedIn?
Do you tweet anymore? Where can people follow?
A little.
All right, guys, scrape together some cash. Subscribe to the Wall Street Journal. For Jason's column alone, you don't need social media. You need more Jason Zweig. And Fleet, where's the camera? We're going to get this? Okay, go to Amazon and buy this. And I am telling you, it will change the way you think about investing forever in a good way. And Jason, thank you so much.
All right, guys,
really
thank you.
appreciate it. Thank you so much for coming. All right, that's it from us this week. Thank you for listening. We'll see you soon.